Hello viewers, welcome back to our channel datascientist.ca. So today our topic uh, is a general topic other than our technical tutorials. So it's our we thought that we should also bring in some different knowledge from different domains to our channel so people can find insights about some different financial domains, like insurance domains, and so on. So, in this regard, today our topic, which we will discuss on our channel, is Registered Education Saving Plans (RESP), and we will go through with this document and figure out what are the benefits and what are pros and cons of this RESP plan in the light of our data driven approach. So let's begin. Uh, a registered education savings plan (RESP) is a special account in Canada that helps families save for child's college, university, or trade school with bonus money grants from the government. It grows tax sheltered, and when the child uses it for school, usually the student will with a lower income pays the tax on the growth and grants. What is an RESP? RESP is a tax advantage saving account for education. Anyone, parents, grandparents, friends can open one for a child. The money can be used for many types of post-secondary schools, including universities, colleges, trade schools, and apprenticeship programs. The federal government adds 20% on your contributions up to 2,500 per year per child, which means up to $500 per year and lifetime maximum of 7,200 in Canada Education Saving Grant (CESG). Low income families may also get extra help through Canada Learning Bond (CLB) and extra CESG, and some provinces like Quebec and BC offer their own grants. So as mentioned, it's a data-driven, all these figures. So we'll have some few key numbers. In 2023, total RESP assets were about 78.9 billion for around 3.1 million beneficiaries, and about 260 new children were added that year. In recent years, roughly 70% of RESP accounts receive some contribution in a given year, with average annual contribution around 1,350 per beneficiary. RESP money is actively being used in 2023. More than 540,000 students made RESP withdrawals with an average withdrawal of around $10,000 to $11,000 per beneficiary in 2023 dollars. At the same time, many parents say high living costs make it hard to contribute at all or regularly, especially in lower income households. What to check before opening? When registering for an RESP, families should slow down and look at a few important points. Type of RESP. Individual or family plans from banks or credit unions, online brokers are usually flexible and simpler. Group or pooled RESPs sold by scholarship providers are often complex and restrictive, and many experts warn people to be very careful with them. Fee and charge. Ask clearly what are all the fees, account fees, management fees, enrollment fees, sales, commission, penalties. High fees can eat big part of your returns, especially in group RESPs where enrollment fees are often front loaded. Flexibility of contributions and withdrawals. Check if you can change the contribution amount, skip contributions, or stop if your situation changes. Confirm what happens if the child does not go to school right after high school or chooses part time study or study outside Canada. Investment choices and risks. Understand what your money is invested in: GIC, mutual funds, ETFs, etc., and the high risk and the risk level. Make sure the investments match your time horizon. More growth when the child is young, more safety closer to school age. Grant rules and deadlines. To maximize CESG, a common strategy is contributing about 2,500 per year per child for 14 years plus 1,000 in the 15th year to reach $7,200 in grants. Learn the age limits for contributions and withdrawals so you do not lose grant money by waiting too long. So families problems families already in RESPs face. Families who already have RESPs often struggle with few recurring issues, especially those in group plans, high fees and penalties, mainly group RESPs. Group RESPs have costly enrollment fee and very stiff penalties if you stop contributing, withdraw early, or transfer out. There are cases where families trying to move a few $1,000s were told they would lose a big portion of it in fee, sometime nearly everything they put in. Complex and restrictive rules. Group plans may only pay out fully if child is full-time student in specific programs, even though government allows RESP funds for part-time studies. Contracts can be hard to understand, and many parents only discover the strict conditions years later when circumstances change. Affordability and contribution gaps. Many parents say living costs, other financial goals, and lack of spare cash make it hard to open or keep contributing to RESP. Low income families are the most affected, and many eligible children never receive benefits like CLB because no RESP is open. Child not following the expected path. If the child delays school, studies part time, chooses a different country, or does not pursue post secondary education, some plans, especially group ones, become difficult to use without losing money. Families then need to navigate rules about returning grants, transferring to an RRSP if room exists, or collapsing the plan, which can create unexpected taxes and grant repayments. For most people, a simple individual or family RESP with bank, credit union, or discount brokerage with clear fees and flexible rules is easier and safer than complex group plans. So viewers, that's the end of our this topic, and we understand that this topic is different than our the goal of this channel. But the domain knowledge uh, is we our goal is to have more domain knowledge in our channel, and based on that, we will develop some data analytics to represent what's actually happening in the market. So that's just a general overview. And if you need for more information, please leave comments and always consult professional for these RESP related plans. But if you have any need more information or anything, leave comments in our comment section and subscribe our channel. Thank you very much and have a great day.